at this moment. It does take us to our talk of the tape, the market's next move, and whether this rebound really can be trusted. We're all wondering that, of course. So let's ask Tom Lee. He joins us now live. Welcome. It's good to see you.
Great to see you, Scott.
So I look at your notes today, and you suggest the worst is behind us. What makes you think that?
Well, I think the thing that we're watching is the VIX spike to 60 on Monday, which is the third highest reading ever, and the VIX futures curve inverted, which was the steepest inversion since the pre-pandemic times. Both are starting to normalize. I think the VIX, as it closes below 20, and it hasn't closed yet, and as that VIX futures term structure uninverts, that tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects, because we know there's some trapped bulls, and there's still some nervousness around Iran and how much of this yen carry trade has to unwind, but I think the worst of the selling pressure is behind us.
How do we know that we had just a growth scare and not something more dramatic to come, Tom? Never mind the unwind of the carry trade, and no one really knows whether that's over either. But when you think about those two events, what does it make you think about where we could go moving forward?
Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday, and a lot of it came from Texas. Texas had a big drop in weekly claims week over week. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds, and next Thursday they'll get another weekly claims number, and if that's also equally improving or stable, I think it's going to give people a lot more conviction.
What about the unwind of the carry trade? I mean, there's no real tell as to whether that's run its course, and that seems to be, the obvious catalyst at the beginning of the week for positioning being well off sides, and it just needed to correct itself. Has it finished?
Scott, that's a great question. Nobody knows how big that carry trade could be. I think there is a large insurance industry participation in that, and I did speak to some insurance executives this past week. As their view is, there's a lot of financial institutions that actually implemented this trade, but if it unwinds in an orderly way, it's not disruptive. It's just that if you have weeks or days like Monday or last week, the end of last week, that's very disorderly, and that gets very expensive, because these insurance companies have to take off these hedges, and then they suddenly have unhedged carry trades.
Well, I just want to continue this. You suggest, if it unwinds in a messy way, there's no if. I mean, we saw at least the first reverberations from that unwind, and that was anything but orderly. What if there really is more of that to come, Tom?
Scott, there may be more of it. I think one thing that has been messy is the currency hedges, because these currency hedges were built for what you'd call like 1 percentile events, 99 percentile standard deviation. So a bigger move than that is what makes these hedges so expensive. They just let them expire. I think central banks can manage currencies within a 1 standard deviation band. So I think it's still important to watch currencies, but if we're staying in stable and predictable ranges, it can be a orderly unwind. But yeah, Scott, that's an uncertainty, just like the Middle East is an uncertainty as well. But markets climb a wall of worry.
Yeah, what do you make of how this week began? Not with necessarily the market upset, but the commentary around it, whether it was Jeremy Siegel of the Wharton School suggesting the Fed needs to come out and do a 75 basis point cut in an emergency way. Of course, he walked that back with our own Jeff Cox yesterday evening. Ron and Son at the beginning of the week suggesting the Fed needs to come out and say something that essentially we've got your back from a liquidity standpoint. Do they need to do something before September's meeting?
Scott, I think both comments from both Ron and Jeremy Siegel are actually valid, but to me, what it speaks of is, I think the markets and I think economists are no longer willing to deal with data dependence. I think they want a Fed that's more forward-looking, because that makes them comfortable the Fed could respond if conditions deteriorate. I think that's the kind of language I'd like to see disappear, is we're data dependent, so that by necessity they're going to be very late. I think it's actually encouraging to see this sort of pushback.
But when you say the concerns from Mr. Siegel are, in your words, valid, you're suggesting that you agree that the Fed needs to come out and make an emergency cut between now and the September meeting?
I don't think the Fed needs to make the cut, but I do think the Fed should, in their playbook, be willing to be forward-looking to respond to financial instability. And I think that that's not language that's been evident in the FOMC meetings or the press conferences and in the minutes. And so I think it's kind of in the right direction, that I'd like to see the Fed less data dependent.
But I mean, isn't that implicit though, right? I mean, if there's the kind of dislocation perhaps that you're alluding to, that's part of their job. I mean, wouldn't they be there in an emergency situation anyway? And I don't know that Monday rose to the level of an emergency situation. It was the first bit of major upset that the market had felt in an awfully long time, and people were at the top of the mountain asking for help.
Scott, it's a fair question, but we know the Bank of Japan felt compelled to speak. I think markets would feel a lot better if there was a sense that global central banks were monitoring the situation. I think there's different levels of forward-looking communication that can be made, which is, we're not necessarily going to act, but we're prepared to act. And I think that's what some of these outcries were really pushing towards.
Speaking of the worst being over, mega cap declines off the recent highs as I look at the list here. Nvidia's down 26%, Amazon's down 16.5%, as is Alphabet, Microsoft about 13.5%, and Apple and Meta are also down, not quite as much as those. Would you suggest that the worst is over in that reset as well, or not?
I think it depends on an investor's time frame. The AI and the capital expenditures that needed to really make up for this global labor shortage, and the fact that these mega caps like Nvidia is trading at 25 times forward 2025 earnings. I mean, these are not expensive stocks where you have to worry about your risk reward over the next 12 months. But will there be a rotation if the Fed begins a cutting cycle that involves 4 cuts this year, or 5, depending on what the futures markets are predicting? To me, that's very bullish for cyclical stocks and small caps and things that are money supply sensitive. So I think there is still a rotation risk, but I wouldn't be a seller of any of these mega caps here.
You just said small caps, which is a good segue for me because I wanted to go there anyway. Of course, your call with me months ago that the small caps could be up 50%, 50% this year. The Russell's up 2.5%, excuse me, year to date. Do you want a mulligan on that? Do you still feel like you've got tremendous upside, but maybe not as much as you once thought? How would you characterize it yourself?
Well, we're still very constructive on small caps. I think the upside is at least 50%, Scott, because they're trading at 10 times, the median Russell 2000 stock trading at 10.7 times forward earnings versus more than 17 times for the S&P for 600 basis points faster earnings growth. But the timing hasn't worked out. I think small caps really shine when the market believes the Fed is going to cut, because it provides so much relief to companies that have high cost of money, whether it's biotech, financials, industrials. I think it's a real saving. It's a lifeline for reducing cost of money for consumers, which helps the banks. You have huge exposure in the Russell. So I think when the market believes the cuts are imminent, or maybe it's September, I think that's when the small cap call works. I think, we've been wrong on the timing. I would like to have seen us to be up 20% at this point, but I still think 50% could happen before year end.
Wow. Before year end. All right, you stick to your guns. Let's expand.